Welcome back to the Michael Gaddis Show on AM 1170 The Answer. We're going to continue our discussion with Richard Shaw of Shaw Financial Services, Inc. That's shawfs.com if you want more information about Shaw Financial Services. That's shawfs.com. Now, in the last segment, we talked a lot about businesses, but I think the one thing that hits everyone, no matter if they're a business owner or not, is that we all have to pay taxes. And tax planning is important to us all. And it's just important for us to contact our tax professional before the end of the year as it is for a business. Isn't that correct, Richard?
Absolutely.
I mean, tell us a little bit about why it's so important for an individual, not a business, to contact someone like yourself before the end of the year.
Well, an individual needs tax planning as well, especially if the individual has sold property. He wants to know where he stands, whether he had a profit or no profit. Was he renting the home? He wants to be able to take advantage of taking a bonus, getting a bonus in the current year, or asking his boss, gee, can you give me the bonus in January? That'll save him some taxes. You want to look at your capital gains. If you take a certain amount of capital gains today and you raise your tax bracket because you took capital gains right at the end of the year, you may have done yourself more harm than good, because it puts you in a different tax bracket, and certain deductions that you would have normally be able to take, you wouldn't be able to take. So you always have to understand that. Another thing with an individual, and I think most individuals don't even know this, but if they've been investing in their own business or a small business of their friends, and the business isn't worth $50 million, and they sell that stock, they could take that money, open up their own business, and pay zero taxes on the money that they've made as a profit. They also could invest that money with another friend, and again, the gain would be tax-free. Also, look at your portfolio, talk to your stockbroker, and make sure that you take enough capital losses to offset capital gains if they exist, and always take short-term losses against long-term losses, because the advantage is very substantial. Short-term losses are ordinary income, basically. Long-term losses are taxed at 20%. If you take a short-term loss to offset a long-term gain, you really increase it, because short-term losses, if there are no gains, you can only deduct up to $3,000.
Well, let me tell you a story. When I first moved to California from Kansas City, Missouri, the home of the championship Royals, by the way, I just had to sneak that in there. But when I moved here, I originally didn't own a house. I didn't own a house, in fact, until 2002. And I was paying taxes, and I didn't really pay much attention to it because I didn't really realize the importance of tax planning. I purchased a house, and after the first year I was in the house, I finally decided to get a tax professional to help me, do my taxes. So when I did it, she sent me over the forms. I noticed I was getting a lot of money back, and it scared me. And I called her, and I said, I have to ask you a question. Are you doing something a little bit? Because I'm a straight, black and white kind of guy. I'm not the gray kind of person. She says, no. She goes, not at all. She says, you bought a house, correct? And I said, yes. And she says, well, welcome to the world of home ownership. She says the tax benefit that you got from owning that house is what, basically allowed us to give you the kind of return that you got. And I was amazed. And that's just a simple example of that's a very basic 101 type situation. So someone like yourself, who is exponentially more qualified per se than the person who did my taxes back in 2002, you could probably take my situation and say, hey, that was great, but I can do even better. Is that kind of what you do?
Well, we do that because we don't just look for the home interest deduction or the sales tax, the state property tax. There's other things. If you're using your home as an office, we might be able to deduct part of that. If you're using your home as an office, we might be able to take advantage of a deduction for using your car. But we also emphasize that when you refinance your home, be careful, because if you take a loan for $500,000 and you only owed $300,000, you might not be able to deduct the interest on 100 of that 200,000. It is better to borrow money and then take that money and put it into an investment other than use it for play of games.
Well, I think what it comes down to is, you see a lot of computer programs, well, you can just plug in the the little areas and it'll spit out what you owe in taxes. But I think that seems to be, like you were saying, you don't just take the regular, here's your interest rate tax deduction, here's your property tax deduction, here's your state income tax. You look at it more in a micro kind of way and try to say, you know what, you might not have thought of this, but I can do this, this, and this. And you ask questions. You actually try to save your people money. Is that right?
Absolutely, because if I don't save you money, I'm not doing you justice.
Yeah, so the goal is to basically, you say, well, look, I'm going to basically whatever fee someone has to pay someone like yourself is going to be more than made up in the benefit that you're going to end up providing them. Absolutely.
Let's take an example of a couple that's either deciding to get married or get divorced. On January 1st, if you get married, you are a married couple for the full year. On December 31st, if you get a divorce, you're single for the entire year. Well, you have to look at what is known as the marriage penalty. So let's assume you and your wife are making about the same amount of money. Isn't it better to finalize your divorce on December 31st so that you file as two single individuals? The answer is absolutely yes. The tax savings can be enormous. They could pay for your divorce.
Right. So it seems like people should just really generally be proactive rather than reactive. And I give this example all the time. It's kind of like you're standing on railroad tracks and you hear a train coming. Do you get off the railroad tracks right when you hear it, or do you wait until it almost hits you before you get off the tracks? And I think most people will say, well, you should get off the tracks right away. And I think that means planning. If you know you have to pay taxes, that's the bell you hear in the distance of the train coming. So you might as well plan. Get off the tracks, talk to a tax professional who can guide you through that process, because simply going and buying one of those online, tax forms or running down to the strip mall, it's not going to give you the benefit of having somebody who has years and years and years of experience trying to help taxpayers save money. Isn't that correct?
Absolutely, Mike. What you have to think about is what I advise clients. If you come in at the end of a year and you show me a contract that you signed and you didn't show it to me before you signed it, that contract may hurt you tax-wise. So I want you to bring in the contract before you sign it. Not that I'm an attorney, but I'm going to look at that piece of paper as a way for you to deduct taxes. As far as whether or not you should stay married or stay single, that's something you look at. But every item that you pay taxes on, and whatever item you can forestall receiving money or increase, you can do the same thing theoretically as a business. You can prepay up to 12 months of a deduction and take it for that year of 2015, for example. And let's assume in 2015, it's been the best year you've had in a long time. Well, prepay your interest for a year on your house, and all of a sudden the tax savings is huge. So you have to look at each year. Are you going to do better this year or next year? And then you throw the deductions into the year that's the best income, and you throw losses into the year of the highest income.
Well, I think that's really important, that, when you're driving around out there or you're listening right now, I think what you need to do is call your tax professional before the end of this year. And I'm not talking about calling them on December 30th. Call them, give them a head start. You need to talk to somebody like Richard Shaw, who actually knows the ins and outs of taxes, because it's going to save you a ton of money. If nothing else, just call him just to see what he could do. I mean, it doesn't cost you anything to do that. Find out. Maybe he can't do anything. Maybe he can. But you're not going to find out if you do nothing. If you just wait until December 31st comes around, and then next day is January 1st, game's over. You're stuck with what you've got for the previous year. Richard Shaw of Shaw Financial Services has joined us today. That's shawfs.com. And yes, Richard, one more
I'd like
thing?
to say one more thing. The month of December is a holiday month. People want to have fun. They're looking at New Year's. They're looking at Christmas. They just got off of Thanksgiving. The biggest Christmas present you will get is by going to your accountant in December because of the money he's going to save you.
So give yourself a Christmas present, an early Christmas present. You contact Shaw Financial Services at shawfs.com. That's shawfs.com. After the break, we're going to go and see or talk about an amazing listing in Fallbrook, California. You're listening to the Michael Gaddis Show on AM 1170, The Answer.
This is AM 1170, The Answer.